When governments don't earn enough from taxes to cover their spending, they issue bonds to fund their deficits. They've been doing a lot of that, certainly since the pandemic. We've seen it in Canada. We've seen it in the United States. As for the buyer appetite for all of that bond issuance, we want to get some more perspective on who's interested in buying these bonds, what the performance looks like, and what you have to consider if you're buying into the fixed income market on the government level. Etienne Bordeleau-Labrecque is a vice president and portfolio manager at Ninepoint Partners, and he joins us here in studio. Nice to see you.
Nice to meet you, John.
So let's talk a little bit more about just how much debt issuance we've seen. I guess, you hear about the numbers in the U.S. It's an explosion, but we've seen a sizable amount of debt issuance in this country as well.
Yeah, I mean, since the pandemic, really, we've seen really high levels of debt to GDP. When you see here the U.S. total debt outstanding, in Canada, it's also at all-time highs on a nominal basis. If you look at it on a percent of GDP basis, which is what a lot of economists look at, in Canada, we're back to levels we've seen in the 1990s, when back then the Liberals were intent on reducing deficits and reducing the size of the state. So we've kind of erased 30 years of prudent fiscal spending with the pandemic and post-pandemic spending.
Those charts alone explain why some investors gravitate towards certain other asset classes. That's a conversation for another day. But, if a company were using this playbook, they might certainly they might issue bonds themselves, or they might issue stock. You need to raise some kind of capital, and investors have to react to that. Oh, is that a good thing or a bad thing for me as an investor with that business? For a government bond investor, is it a good thing or a bad thing?
Well, it really depends where you invest in government bonds. You can buy T-bills that are 1 month, 3 months, 6 months, 12 months, in which case it's less relevant because higher interest rates mean you earn more on that T-bill. Like right now, in the U.S. you make 5.25%, in Canada about 5%. So don't take a lot of risk. When it matures, you can buy another one. If the rate's higher, it's even better. If you invest in longer-term government bonds, that's another story. That's when you can get hurt. When interest rates go up, you can lose a lot of capital pretty quickly.
So just the idea that there is more debt being issued means there's potentially more investors in the fixed income world, and then more potential exposure to whatever's happening with things.
And we've seen that over the last year and a half. Money market funds have increased in size because people are taking advantage of these really interesting short-term interest rates. So high interest savings funds, money market funds that invest in short-term securities, often government bonds, but short-term government bonds have yields that are really attractive for investors right now. We haven't seen that in 15 years. So there's been a lot of money flowing into money market funds. In the US, it's been a really large increase, and a lot of the excess bond issuance that we've seen in the US over the last 2 years has been directed towards T-bills as opposed to longer-term bonds, which are harder to absorb by the market when there's such a large amount. So more T-bill issuance is going to money market funds, and that's how the market's been able to absorb this supply quite well.
Interesting. We've been talking with Bitcoin, for example, about how you have these ETFs that were launched in the United States, and sort of this common dialogue is, well, it broadened out the possible investment base in that asset class. When there's a lot of issuance of short-term securities in the debt market, is it the same investor base, just an investor base that's used to buying the short-term debt, or has the investor base changed at all?
Well, I think households are certainly buying more just through these money market funds. So you've seen a lot more increase in money market funds, and so the AUM of these funds is going up. So that's mom and pops putting money to work, taking cash out of the bank that yielded nothing, putting it in something that yields something, low fives these days. So that's a big shift. And so we're seeing that across the developed world. Banks are seeing deposit outflows because they don't pay enough on their deposits, and inflows into money market funds.
Okay, so governments have deficits. They need to finance those deficits by issuing debt. They go to the market. They find that there's a pretty good appetite for shorter term debt. And in this environment where interest rates are on the move, all of a sudden people start looking at those investment opportunities versus a good old-fashioned bank account that doesn't pay you a lot.
Yeah.
So that explains some of the moving parts of the mechanics. But what is the most important thing, especially for an investor in some of those shorter dated securities, to be thinking about for the rest of this year?
Well, interest rate cuts. So if the Bank of Canada or the Fed start cutting rates, well, you earn less on these short-term securities because they roll over pretty quickly. So if the consensus right now is about 3 rate cuts in Canada and the U.S. by year end, so you go from earning 5 or 5.25 to 4.5. That's a meaningful difference. So people will have to start thinking about what to do with these high interest savings funds, these money market fund holdings. Are they happy with 4.5, or do they want to migrate to different types of products?
And will their level of happiness be watched closely by governments themselves, since they've been the ones issuing this short-term debt? In other words, it's not like we're getting back to balanced budgets in North American or in Canada and the U.S. anytime soon. So they're going to have to keep financing.
Yeah.
If the appetite for those bonds starts to change, does that change the kinds of bonds that become available in the marketplace for investors?
Well, so it depends a lot. So there's 2 sides to this. One is the demand side, but also as rates go down, it becomes less expensive for the government to issue these bonds. Mm-hmm. So the interest costs are lower. So we'll have to see what happens with other asset classes, as you mentioned earlier, also makes a big difference. If all of a sudden people find equities to be too expensive, for example, maybe they want to hide in government bonds again, and then at which point you might see a lot of appetite for a 10-year or 30-year government bonds from investors looking for a safe haven.